I gave up managing billions to become a better investor. Episode 38, nearly end of quarter three. Hello. Yes, it's nearly the end of the third quarter period of the year. And of course, that means the inevitable, and it's upcoming this weekend, appraisal of what's performed and what hasn't in the global investment markets. More on that in a few days. But we've had an interesting last week or so in the investment markets. Since my last podcast, we've seen the Federal Reserve and Bank of England decide not to raise interest rates. I think that's very smart. Finally, a bit of good insight there. But we've also seen some quite clear volatility on global markets. In fact, actually, the fear and greed index, which I often quote and talk about, interestingly, we're into extreme fear now. And of course, that means investors should be thinking, hang on, isn't there an opportunity now to invest some money or some spare capital that you've got and matters like that? And I would kind of think there is. But of course, we've got the most interesting potential insight upcoming in 2 or 3 weeks' time with the new quarterly earnings season period. But more on that, I say, this weekend when we appraise quarter three and ultimately over the next week or so think about the next quarterly earnings season. But markets have been a little bit more volatile over the last few days. And it's kind of interesting, despite the fact that the Fed and the Bank of England decided not to raise rates, we've had bond interest rates, bond yields going up. And of course, bond yields going up, prices going down. Kind of interesting. Why is that? What's happening? And you have to, as always with central bank sort of analysis, go back and sort of say, well, is there a kind of a bigger story here? And I guess the Fed's particularly impactful here. And it's kind of fascinating to look at 10-year US government bond yields versus, let's say, the equivalent ones in the UK. And there, for the first time in well over a year, you're actually having 10-year US bond yields at a higher level than their equivalent peers in the UK. So why is that? Why are because I thought that the UK had a bigger inflation issue and related, be it Brexit matters or whatever people want to talk about, what has caused a sustained level of inflation more than in other countries here in the UK. So why are bond yields higher in the US? And we come back down to, again, what really drives bond markets. It's not just what is inflation today or what is it going to be over the next few quarters or 18 months or so. It's not on where are interest rates today and where they're going to go tomorrow and over the next year or so. But you've also got to think about matters such as debt, and that's obviously a potential issue in the States, given that once again we've come into an interesting period when US politicians may or may not be sensible about finances and related. We shall see about that. As always, the kind of the fear of a default in the States starts to go up, and reality, of course, is that they're not going to default. It's just everything's pushed back a little bit in terms of the decision timing of all of these issues. But I think when you sort of push into the fact that the Fed admitted that it's going to take a little bit longer, even if they may not be raising rates any further, still some talk about they will raise rates later on this year again. I think that would be not madness is probably the wrong word, but an incorrect policy decision, let's put it that way. It's going to take longer perhaps than expected for them to be decreasing rates, whilst by contrast, when we think about the UK, lower growth levels in all likelihood again next year, as we've seen this year too. I reckon the scope for US versus UK interest rate reductions is probably better suited to the UK. That would be my guess over the next year or so. Now, of course, we've got politics ongoing. Both sides of the Atlantic actually have interesting elections coming up in the next year or 13 or 14 months or so. But what's fascinating to me is the fact that actually I think there's an acknowledgement that perhaps that kind of a bit more growth, a little bit of a more of an overt debt issue in the States, and of course the fact that US interest rates are slightly higher, that's attracted some people to say, well, maybe US bond yield should also be a little bit higher. And again, I think it's going to move around in due course. My instinct is still, I'm not particularly excited, as you well know, about the prospects for bonds over the next year or two, but I'm not too overly pessimistic either. They're kind of, yep, it's going to make you a few percent. It's probably going to do better than money in the bank, certainly better than money under the covers of your bed or something. But is it as remunerative potentially as equities? Particularly now that we're into this deep fear moment in equity markets, as per the fear and greed index, at least. My feeling would still be that the average investor it's smarter to be allocated to equities rather than bonds. That would still be my perception. But more insights coming from the corporate earnings season in a couple of weeks' time or so. Interesting to see, looking at the graphic as I speak at the moment, the fact that in the US market, you've actually seen more countries choose to reduce their dividend yields than increase them in over the last quarter or so. Or at least it's very close now, when it used to be over, my goodness, I'm looking at the graphic now, over the last, 3-4 years, it was clearly massively in favour of the more increasing dividend angles by companies, rather than those deciding to reduce them. So, as always, I guess what is perhaps more overtly interesting is the fact that fewer companies are changing their dividends per se, which I think is perhaps a more reflective indication of the fact that there has been clearly a few new challenges, slightly less growth perhaps than people would have thought, and certainly the acknowledgement that you've got things such as higher bond yields and interest rates. Consequently, companies have a little bit more to deal with on the background, rather than just pay out dividends and increase them all the time, etc., which, as we all know, would be nice to talk about, but that's not the reality we live in. Reality is a lot tougher than that. Tell you what else is interesting. That is, I was going to talk about gold again, but kind of a nice segue into what I probably have got to talk about, which is FX rates. Kind of interesting to see gold prices falling below $1,900 again, which is, for gold bulls like myself, was a bit disappointing, except, of course, gold is dollar denominated and the dollar has gone up. And often you see this when the dollar starts to go up, and it's kind of interesting. We're now about circa a year since the great UK sort of financial volatility, as the previous Prime Minister and her Chancellor had a few local difficulties, shall we say, in terms of some of their policy aims and efforts, and neither lasted in their respective jobs particularly quickly or for a long period of time. And what's kind of interesting is that the big sort of fear at that time, of course, was that, oh my goodness, we're going to see again of $1 pound level, and of course we never got to that. But it's interesting that after sort of flirting with that kind of 130 level a few months ago, we're now back down to 121 and change. And it's kind of interesting to see the dollar generally going up. We're just a little bit off the 150 level against the yen, for example, which is, I think, going to be an important moment when it inevitably seems to occur at some point over the next week or so. Why is the dollar so strong? And hence, I guess, why is the gold price a bit weak? Well, the latter is kind of easy to understand. If you've got a dollar-denominated asset, then guess what? If there's no kind of mega underlying driving reasons why suddenly gold's interesting, although I would argue that, frankly, thoughts about debt, still considerations of higher interest rates for longer periods and related, you could still make a case even for a lower yielding asset or no yielding natural asset such as gold. You don't need to be holding bonds. Frankly, the mix of bonds and gold, you could say, if you wanted to move away from equities, would make a lot more sense than not. But nevertheless, on a sort of ceteris paribus basis, if we don't have, if we have a rising dollar, then yes, you're going to get a sort of a slightly negative headline gold price. But obviously, in sterling terms, in yen terms, the gold is still doing all right, which is, I think, a fairer reflection of where we are in the world. I know you can get a slightly higher yield than you could have got on bonds or corporates or whatever it might be in that part of the market. And maybe that says, well, I'm getting some yield, I'm not getting any yield on gold, therefore switch more towards bonds. But the trouble with bonds is, and we come back to this notion again, people have got to get around their heads. We're not in the 2010s Mark II. We're in a different decade with certainly different aging populations, rising debt pressure issues. You put all of those together and you would expect a higher bond yield. You've got to be given a higher reward for earning your bonds because there are greater fears out there, be it at corporates or be it, frankly, in government bonds too, which is where gold, with its different sort of focus in that sort of market, still makes a lot of sense. Should the dollar, though, be going up? If the Federal Reserve are likely to have high interest rates for a little bit longer. Okay, those interest rates are at a higher level than you can see in the Eurozone, in the UK, and materially, obviously, versus Japan. Should that all be supporting the dollar? And of course, FX doesn't work that way normally, certainly over the medium term. It's not. There is very limited correlation between higher interest rates and a strong currency. Frankly, there comes that point when either interest rates start to go down and people have less of a rationale to own a certain commodity. But frankly, when people have high interest rates, they're there for a reason, typically. And when I look at the States, do I think that, I guess your rationale for the US can justify higher interest rates because it's got more growth and more potential for inflation, and therefore the dollar should be stronger because you're not only getting yield, but you're also getting growth and everything's going to be great. I guess if you're a super bull on American assets, then yes, you could make a case. But as we talked about on a previous podcast a week or so ago, and you can certainly see it when you look at the share price of ARM or Nvidia recently and other either new or loved areas, certainly even some of the broader well-known tech companies have seen a little bit of share price weakness. They're sensitive to areas such as, unfortunately, things like higher bond yields and related, even though they're not particularly borrowing money in many cases. It's just that sort of, oh my goodness, what's the justification for buying sort of a highly rated equity asset when actually this high bond yield is now giving a little bit more fear or a little bit of an alternative out there. So that's why, as I've talked about in previous podcasts, I would still be feeling that, and this is certainly very true a couple of months ago, slightly less true today. We're back down to, oh my goodness, we're into a more fearful situation. Therefore, find your opportunities in equities. But generally, I'd say that high technology focus in the US markets just makes me concerned about US equities per se. And even though, yes, there's people saying, yes, the dollar justifiably is going up, and yes, you should be factoring that into your choices as a global investor. But my fundamental feeling would remain that the dollar is a bit too firm, actually. I don't see it justifiably being, let's take it against sterling or the euro, for example. Should we be at higher levels? Let's call it 10% plus higher against prevailing levels for both the sterling and the euro. The answer, in my opinion, is yes. I think that's fundamentally true. It's certainly plausible, very plausible, that you may see less growth in the Eurozone and the UK over the next year. But I would say some of the issues or potential issues in the States, be it the election, be it the aforementioned shorter-term debt matters, they're things you've got to try and factor in too. Generally across, I guess, particularly the developed market world for core global investors, there are reasons not to be expecting a massive rally in bonds because there's suddenly wondrous total return value there. I would still say that a carefully sort of selected range of equities still makes more sense to me, and mixing things like gold, true alternative assets like that make a lot more sense. Of course, with equities in particular, and to some extent with gold too, as I've talked about stocks such as Barrick Gold before, but certainly when you think about equities generally, this brings us back to the massive pre kind of corporate earnings season sort of musing about where are we, where do we think we're going to go in quarter four, what is the quarter three numbers going to say, what should investors be doing over the final quarter of the year. And that will become some thoughts about quarter three performance per se on the next podcast, and then bring it into over the next week or so, what on earth is happening with the next corporate earnings season. I guess what I'm trying to say is the world remains interesting. And from an investor's perspective, I still find a good range of opportunities. I'm chilling at the moment in the sense that I'm highly invested. I still remain circa nearly 90% invested in a range of global equities, circa 10% in gold and gold, directly gold related assets, and a very small proportion, just a modicum, 1-2% in cash and cash related matters, a bit of dry powder for other assets, other opportunities that I can find. That still remains my perspective. And yes, there's been a little bit more volatility in markets over the last 2-3 weeks. Am I particularly worried? No, I'm not. What I'm looking forward to is a bunch of interesting corporate earnings updates over the next couple of months, and the chance to sort of appraise whether those investments still remain smart, whether other ones are out there and related. It is, as I've said before, an active investing world, and consequently, it's not an area to be pessimistic or sort of kind of quiet or passively invested in. It's a world to be actively invested in, but you have to embrace the news flows and the insights, be it macro, be it sector, be it company, mix it all together and see what works. That is always the exciting sort of backdrop to the investment world. Anyway, enough of this podcast. We'll come back at the weekend talking about quarter three realities, and I look forward to talking with you then. Thanks for listening, and bye-bye.